If you are an Indian living in the US, you have ever tried to invest in India, you already know the problem. Every NRI YouTuber tells you to buy Indian mutual funds. Your CA in India tells you NRI FDs are tax-free. Your American CPA probably doesn't spend much time thinking about Indian investment products. And somewhere in the middle of all this, you are sitting on dollars, watching the rupee and wondering, am I doing this right? In the next 12 minutes, I am going to give you a framework so that by end of this video, you can look at any Indian investment product and instantly know three things: where it fits in your portfolio, what it actually cost you in tax, and whether you should touch it at all as a US person. Let's get into it. Before we talk about what to invest in, you need to internalize one fact that 90% of NRI content on the internet completely ignores. As a US person, you are taxed on your worldwide income, not only on your US income. IRS doesn't care where the asset sits. If you own it, you owe on it. This single fact changes everything. It changes which Indian products are smart, which can create serious tax problem, and which need to be reported properly. Three acronyms you need to live with. Number 1, FATCA. The reason most Indian mutual fund houses won't even open an account for you. They don't want the compliance burden of reporting your holding to the US. Second, PFIC, Passive Foreign Investment Company. This is the silent portfolio killer. If you buy an Indian mutual fund or a gold ETF, the IRS treat it as a PFIC. The tax treatment is so punitive that in many cases your entire gain plus interest gets taxed at the highest marginal rate. We will come back to this. Third is DTAA, the India-US Double Taxation Avoidance Agreement. The good news, it means you don't get twice on the same income. And the bad news, you have to file in both countries to claim the credit. Hold these three in your head. So we go through every product. And here's the one idea that emerges. When you put all the three together, the line I want you to carry through the rest of this video. The wrapper is the tax. The product doesn't determine your return. The legal wrapper around the product does. Two NRIs can buy the same Indian growth story and walk away with differently after-tax outcomes purely because of the wrapper. Now your foundation of you can't invest in India without the right plumbing. Two core accounts to know. NRI account, you fund it from your US salary in dollars. It converts to rupees. The interest is tax-free in India, fully repatriable. And this is the part Indian advisors skip. That interest is fully taxable in the US and you still need to report that income on your US tax return. Now second, NRO account. This is for income that originates in India, like your rental, dividends, or any pension income, sale proceeds. 30% TDS in India. Foreign tax credit in the US. Two more you may need. FCNR deposit if you want USD denominated India exposure with no rupee risk. And PIS if you will trade individual Indian stocks. We will come back to both. At minimum, you need an NRE and NRO account. Everything else flows from there. Now, here's the spine of everything. Forget products for a minute. Decide your allocation first. I use a simple 3-bucket structure with most of my NRI clients. 3 questions decide where you sit. 1. When are you going to need the money in rupees? Returning in 5 years, you need debt. Never going to live in India again, you can hold more equity. 2. What are your INR liabilities or goals? Like parents in India, a property you may buy, kids' education here, match the currency. Now 3. What's your US tax bracket? A 37% bracket NRI cannot afford to play games with PFICs at all. Once you know your allocation, then we pick products. Not before. And most NRI do this backward. They buy what's trending, then they try to reverse engineer a portfolio. That's how you end up with 8 mutual fund, 2 PMS scheme, a real estate deposit, and zero clarity. And most important, keep getting the mail from FATCA about the different residential station. Now, I am Kashish Manjani. I am a SEBI RIA advisor at AKM Wealth. I work with US-based NRIs on this problem every day. What I am about to walk you through is the framework I use in actual client conversations. Real answers, real numbers. Now let's go bucket by bucket. Bucket first. This is the foundation. 3 accounts one trap. That's your entire debt framework. NRE fixed deposit, your INR exposure, currently around 6.5 to 7% tax free in India, but fully taxable in the US. So 7% headline becomes about 4 to 5% post US tax. And if your future spending is in dollars, you also need to think about currency movements. A 7% rupee return and a 7% dollar return are not the same thing. Use it for money with INR purpose. Now your FCNR deposit, your USD exposure. Same Indian bank, deposit held in dollar. Lower yield, 4.5 to 5.5% return, but no rupee risk, and it's wildly underused. Now third is the NRO deposit. Operational for money that already sits in India or you're getting from any Indian source. 30% TDS, foreign tax credit in the US. You can call it a holding tech, not a strategy. So that's the framework. NRE for INR exposure, FCNR for USD exposure, NRO only for Indian origin money. And third, the trap, debt mutual funds and bond ETFs. PFIC, don't touch them. The tax treatment can dramatically reduce your after tax return once the PFIC rules apply. Notice the pattern. Same underlying asset, mostly the interest income, but 4 different wrappers and 4 different outcomes. The wrapper is the tax. 3 accounts, 1 trap, move on. Now let's talk about bucket 2. That's your equity bucket. This is where most US NRI get the most wrong. Not because they pick bad stocks, because they pick the wrong wrapper to hold equity in. Let me show you what I mean. Direct stocks via PIS, the cleanest equity exposure for a US NRI. Open a PIS linked demat, buy individual Indian stocks. Indian taxes, capital gains, around 12.5% for long term, above 1,25,000, and for short term 20%. The US taxes, the same gain. You claim a foreign tax credit through DTAA, as we discussed. Now why it works? You own the underlying company directly. No PFIC issue. You're not inside a pulled vehicle. That's your growth bucket. Long-term wealth creation. But the catch, stock picking is very hard. If you don't have time, expertise or an advisor, don't get into it. Now Indian mutual fund. If you are a US-based NRI, this is the category to be most careful about before you add another rupee. And review the PFIC implication with a qualified cross-border CPA. PFIC. So how does it work? Either mark to market or excess distribution regime. Both can result in much higher tax bill than most NRIs expect. A 12% nominal return can look very different after PFIC tax and compliance costs are factored in. Add form 8621 for every single fund, every single year, and most AMCs won't even open accounts for US NRIs anymore. The universe is shrinking. For most US-based NRIs, the math doesn't work. But existing holdings need careful unwind, not panic. That's a conversation with a CPA. Indian ETFs. Indian ETFs have the same PFIC problem. That's why some US-based NRI choose to get Indian exposure through US-listed products sometimes. The important point is not the product. It's the understanding the tax wrapper you are using. And for your satellite allocation, if you have the risk appetite, PMS, AIFs, for especially the HNI investor, it makes sense. For PMS at 50 lakh minimum, give concentrated direct equity. No PFIC issues. AIFs at 1 crore minimum. And PFIC depends on the structure. So understand that first. Get a tax analysis before you commit. And pre-IPO requires total loss appetite. High minimum, long locking, manager selection is everything in this. You're not investing in a product, you're investing in people. These are satellite allocation. They are not the foundations. The lesson of this entire section for US NRIs, PFIC matters more than the product selection. Two NRIs can pick the same equity story, hold it through different wrappers, and end up with completely different after-tax outcomes. Get the wrapper right, the stock comes second. The wrapper is the tax. Now, your bucket 3, real estate. Direct real estate. You can own residential and commercial property in India, which, let's be honest, is still probably the most loved asset class among NRIs. But not agricultural land, not farmhouse, not plantations. You cannot hold them. So, what to expect? Rental income credited to your NRO account. and capital gains tax in both countries with DTAA credit. Repatriation up to $1 million per year. The honest challenge. You are managing a property from 8,000 miles away. Tenant, maintenance, society politics. So sometimes the romance dies in 1 year. So my view is simple. Buy property in India is for use but not for return. If you want diversified real estate exposure as an investment, REITs and InvITs are often a better answer. REITs and InvITs are listed real estate vehicles. For most US NRIs, this is the cleanest way to own Indian real estate. Use them. Now, here is a sample allocation. If you are a 38-year-old US NRI, $400,000 you would like to invest in India and for 15 years horizon and still undecided on return. 40% in core debt like NRE FDs plus FCNR deposits, 25% in Indian equity via direct stocks or via PIS. Now the 3 rules to remember. I have put together a full operational checklist. Link is in the description below. Open accounts the right way, find the right CPA, run PFIC test, track DTAA credits, grab it after the video. For now, if you forget everything else, remember this 3 rule. Rule number 1. Own the asset, not the wrapper. Direct stocks, direct bonds, REITs, PMS is fine. Indian mutual fund and Indian ETFs are usually a PFIC trap. Now, rule 2. Match the currency to your liabilities and your goals. That's the key idea. And rule 3. Get your taxes done by someone who understands both the sides. An Indian CA will miss your US PFIC obligations and a US only CPA will miss your Indian DTAA credits. You need someone who does both. That's the framework. Not a list of best funds, a way of thinking that will serve you for the next 30 years. If you want this customized to your numbers, your income, your assets, your goals, and your timeline, at AKM Wealth, we work with US-based NRI on exactly this. We are fee-only fiduciary. Link to the discovery call is in the description. If this gave you clarity, hit subscribe. And in our next video, we will be breaking down the exact PFIC math on a single mutual fund holding. So you can see in dollars and cents what it actually cost you. Until then, invest with clarity.